most of the money when it comes to the equity markets, the bond markets, is really made when you find regime changes. For example, in late or the fourth quarter of 2019, when we started calling for bond yields to collapse, and then last summer of 2020, the opposite, and equities rallying, all those kinds of really structural changes almost. And I wanted to highlight one here today that it's not an imminent one to react to, but one that we think is taking place and is going to be among us for a longer period of time. And a lot of it really has to do with what we think is now the popping of the passive investing bubble. It's something I've been talking about for several years now, that there's a major risk of that taking place, and that when it would take place, that a more proactive approach, not a hectic approach, but a more proactive approach would become absolutely pertinent for you to be able to continue to make money in the markets, whether that is your longer term nest egg in your retirement accounts or in the near term. So I brought along, I think, 3 charts that give us some pretty good perspective on this. The first chart is, and these all 3 are going to be what's called a logarithmic chart, because they're such long-term charts that we want to put them in the right perspective. So here what I did is I took the financial or the technology sector of the S&P 500 tech sector, and I divided it by the financial sector. And you can see that tech has had a massive relative outperformance versus financials over the past decade or so. But that outperformance has started to stall and develop this sort of rounding top. And you can see what's taking place now is that this rounding top is starting to break down. Now, as is the case for the other 2 charts I'm going to show you, I think near term this is overdone. But I think the path of least resistance here is continuing in the direction of technology, particularly the NASDAQ 100, underperforming, relatively speaking. That doesn't mean those stocks can't go higher, but they will likely underperform. So this is one way of looking at it. Another way of looking at it is by taking value stocks and dividing them, growth stocks, and dividing them by value stocks. Same concept, massive outperformance for the past decade or so on the part of growth stocks versus value. Then they started to stall, and now we've broken down. Again, I think short term this is oversold, but the structural change, the regime change, I think, is here. And then the third chart, and I think this is arguably the most important one, is if we take, let's say, the S&P 500 and we divide it by essentially stocks outside of the US. And even though the breakdown here hasn't happened in a big way, you can see it's the same situation. We have mega cap stocks, basically the S&P, outperforming the rest of the world for the past decade or so, and we're starting to break down. And the common denominator in these 3 things is very simply just a few extraordinarily heavily weighted equities, from Tesla to Apple to others, that are essentially holding up or have been holding up the S&P. We've been beating the drums on this now for an extended period of time, how when that bubble pops, specifically that S&P bubble, the average stock will outperform. We talked about this as one of the major trades coming into this year, that the equally weighted S&P 500 will likely outperform the S&P, which is taking place in a meaningful way right now. But also what that would lead to in terms of, bigger picture sort of blow-ups of passive investing bubbles. And we think we're there, and these are really important charts. So I hope this is helpful. Give us a thumbs up, and leave a comment if you have any questions, and we'll see you in the next video.